The U.S. jobs report is out today and will be a point of focus as per the usual after seeing a bit of a dip in the numbers as reflected through a couple of gross disappointments earlier this year. The data has improved and is getting back to trend. That trend is one which on its own would be easily arguing for higher interest rates if not for this prolonged period of subdued inflation and bigger picture risks to the global economy, including U.S. trade and Brexit. As we head into the weekly close, the market has been feeling a lot better about those bigger picture risks, with China coming back to the negotiating table and Brexit no-deal prospects reduced. And so, if today's employment report manages to produce numbers that come in line or exceed expectation, the dollar may want to come roaring back while stocks may once again tumble up from elevated levels. The reason being that the Fed would be feeling better about the mid-cycle adjustment language from the recent meeting, which follows along with the narrative that policy normalization is still ongoing. If, however, the report produces a discouraging result, the US dollar could sell off on an expectation the Fed will bend to the will of the president and look to lower rates more aggressively. This could also inspire that same demand for stocks we've been seeing for over a decade as investors find comfort in a lower for forever policy strategy outlook. But what makes today a little more interesting and what makes the reaction to the jobs report less interesting is the appearance of the Fed chair later in the day when he offers his assessment of the economic outlook. The market will be ready to hang on every word that comes out of the mouth of Jay Powell, and it will be wondering if there is any evidence of the Fed chair moving in the direction of a more aggressive shift back to the dovish side. As far as the jobs report go, the expectation for NFPs is 158K from 164K previous. Hourly earnings are expected to hold steady month on month, and the unemployment rate is also expected to hold steady at 3.7% year on year. That's all for now.